Hi, everyone. I'm Heather Ogan, Administrative Partner at FLG Partners, the leading interim CFO, COO, and board advisory firm in the US, serving clients globally. Welcome to our latest roundtable event, Code Red in Retail, Strategies for Success. While it is clear that the retail sector is facing daunting challenges right now, the good news is that many retail and consumer companies have pioneered successful solutions despite these tough times. To tell us more about these innovative strategies, we have with us today two highly experienced FLG partners and consumer-centric CFOs, Jennifer Cho and Monica Stevenson. Each of these accomplished women have more than 20 years as senior executives and CFOs at both private and public consumer companies. Both have seen firsthand the dramatic impacts to the retail sector, from changing economic, technology, and consumer trends over the past couple of decades. Jennifer Cho has over 30 years of financial and operational experience in public and private companies, from spanning consumer products, entertainment and digital media, technology, and investment banking. Before joining FLG, Jennifer was EVP and CFO of Otter Media and held C-suite roles at AT&T's Entertainment Group, DirecTV, and Gap. Monica Stevenson came to FLG with over 20 years of finance and operations experience and over a decade of specialized expertise in consumer and luxury goods, apparel, beauty, and retail. Monica has broad executive management experience working for global brands, including Yves Saint Laurent, Dolce & Gabbana, Tourneau, and Versace. We also have with us today a distinguished guest panelist and former governor at the Fed, Bob Heller. Bob's career over the last 4+ decades spans teaching, banking, business, and government service. Bob joined the IMF before becoming SVP and Director of International Economic Research at the Bank of America. In 1986, Ronald Reagan nominated him for the Board of Governors at the Federal Reserve Bank, where he served until 1989. After the Fed, Bob became president and CEO at Visa USA. Today, he is active at the board level in many business and civic organizations. Welcome, panelists. Let's get started. Good morning, Bob. Why don't we start our discussion with a review of what you're seeing on the macroeconomic front when it comes to retail trends? We're curious about what you see on the horizon for 2023 and 2024. Are we on the cusp of a recession, or are we already in a recession, Bob? What data is informing your point of view here, and what do you think we'll experience, a soft or a hard landing?
Thanks, Heather. So glad to be joining my fellow panelists today. I think we're in the middle of a double dip recession right now. As you all know, we experienced 2 quarters of negative economic growth in the first half of the last year, thereby meeting the classic definition of a recession, 2 quarters of negative growth. The third quarter saw somewhat of a rebound with 3.2% growth, and the fourth quarter will probably show similar results once the final data are in. But the Fed tightening and the resulting increase in interest rates will have a negative lagged effect on the economy towards the middle of this year, which will make a second recession most likely. We will therefore face a double dip recession.
Wow, that's very insightful, Bob. In light of all that, let's now turn to the consumer. What do you think inflation, fear about a double dip recession, rising interest rates, and a cooling job market will influence consumer confidence, demand, and overall behavior moving forward?
Well, the higher interest rates engineered by the Fed will obviously make things a bit more expensive for consumers to buy, especially items that are typically bought on credit, like houses, automobiles. And these interest-sensitive sectors are already slowing down quite a bit. In addition, Federal Reserve stimulus payments, not Federal Reserve, but federal government stimulus payments that were designated to counteract the effects of the COVID shutdowns will come to an end and further restrict consumer spending. So I would expect that consumer spending will be quite muted going forward from now on.
Thanks, Bob. My next question may be of particular interest to international companies. We are part of a global economy, and lately the dollar has been favored over other currencies. How do you think consumer companies will be impacted by currency headwinds in 2023, if at all?
Well, it's a rather complicated question. The dollar appreciated some 15% prior to October last year, largely due to the Fed raising interest rates here at home. And that led Americans to spend more of their vacations abroad buying cheaper foreign goods. But since then, other central banks have also tightened their policy stance and thereby neutralizing part of the exchange rate effect. Therefore, I wouldn't expect that exchange rates will have a significant effect on US economic growth.
Thank you, Bob. Your comments provide a really great framework for the current realities facing both private and public companies in the retail sector. I'm sure everyone in the audience has been taking notes. I know I have. Clearly, CEOs and boards are on the hot seat when it comes to preparing for these future scenarios, both tactically and strategically. So let's begin our discussion with some of the immediate 2023 priorities facing retail and consumer CFOs. For starters, let's consider inflation. Inflationary pressures have really tested many companies these past couple of years. Jennifer, I'll start with you. What do you see as the best ways CFOs and their teams can combat inflation for 2023? For instance, when and why do you decide to raise prices versus, say, taking a margin hit and trying to preserve market share?
Well, thanks, Heather. I'm thrilled to be on this panel with you as well as Bob and Monica. Back to your question. Inflation has been a real issue since mid-2021, and it continues to be a problem. We start to see rising costs in 21 driven by supply chain disruptions and followed by skyrocketing energy prices globally after the war broke out in Ukraine. And while inflation had eased a little bit in the last few months to 6.5%, don't forget consumer prices were as high as 9.1% just 6 months ago. The current situation going into 2023 is not ideal, as most retailers are sitting on excess inventory with continuing macroeconomic headwinds, high inflation, rising interest rates, and as Bob pointed out, a possible double dip recession. The good news is that the consumers are still spending, but the data shows the spend is more focused on services rather than on hard goods. In response to these market conditions, we saw many consumer-centric companies raise prices to protect their margins in the face of rising costs. Of course, if your brand is strong and in high demand, this is much easier to achieve. The smartest companies are constantly surveying the market to understand their product competitiveness and consumers' willingness to pay for their goods. So evaluating price demand elasticity with the help of a third-party research firm may be beneficial if you don't have a sufficient in-house staff to conduct this type of pricing analysis. Is something you may want to take on. Now, if you're running a wholesale business, it'll be critical to work with your retail partners to understand their sell-through trends before you consider any price increases. It's interesting that while some companies have raised prices, some companies have chosen not to do so in order to protect or possibly gain market share. So as a CFO, you must figure out which pricing strategy is right for your company, as there is not one common solution for everyone. Does that make sense, Heather?
Those are really great points, Jennifer. Thank you. Monica, do you have anything to add to Jennifer's perspective here?
First, good morning, Heather, and thank you for having me on this esteemed panel today. I agree with Jennifer's points and would just add that undertaking price increases should not be done without the solid pricing analysis that Jennifer mentioned and also competitive scans. While supply chain and labor challenges have indeed increased costs, the obvious solution to increase prices is not always the best solution. For example, many of my clients have delayed price increases, choosing to follow rather than lead the rest of the market. Once they have seen that other key movers have taken an increase, they have then done so accordingly. Factors that we have considered are first, the timing of when we take these price increases, generally making sure that you don't interrupt your seasonal cadences. So for example, if you have a seasonal business and you follow fall, winter, and spring, summer calendars, You want to respect those as you take price increases. Also, if you operate in that wholesale channel, as Jennifer mentioned, you need to ensure that you gain alignment with your wholesale partners. You have to take the pricing increases in conjunction with them. And last, understand the negative impact to your unit throughput that can happen as a function of the price increase. In the best case, these would offset one another, but you don't want to go into this blindly. I would like to add a final point about what a CFO can do to combat inflation. And that's a key area, and it's discretionary spending. In an inflationary period, the most astute CFOs are taking defensive actions to limit their spendings at their companies, their cost pruning, and taking measures to ensure sufficient cash reserves.
Thank you both for these great insights about how to manage pricing around inflationary effects, ladies. Now let's move on to managing inventory. That's another important retail imperative. A key issue retail CFOs are grappling with as we head into 2023 is adequately forecasting consumer demand, and in some cases, dealing with a glut of inventory. Monica, what approaches do you recommend when it comes to proactively avoiding inventory overages? What works?
Another great question, Heather, and one that's quite pressing and relevant. Managing inventory to optimal levels presents greater challenges during a recession than it does during a normal economy. Holding too much inventory ties up your cash and does absolutely nothing to improve your sales. The last couple of years has challenged even the most sophisticated companies, as supply chain lead times nearly doubled versus your typical levels. Here's why it's been such a crazy ride for our consumer-based companies. In 2020, we saw overstocks as companies were left with excess inventory as a result of slower spending during the early days of the pandemic. Then in 2021, we saw stock shortages. Demand spiked coming out of COVID restrictions, and port closures and labor shortages continue to increase the lead times for products arriving on shelves. Then in 2022, to proactively avoid those stock outages again, companies took on larger inventory positions. And here we are today in 2023. We're in the midst of global inflation, a double-dip recession, which means slower consumer demand again and potential overstock situations. What I do with my clients is a couple of things. The first is I ensure that we have real-time, ongoing inventory review planning. If you have today still a process where you're looking at your inventory only seasonally, you should move those analyses up to at least monthly. The second thing I like to do, where possible, is utilize predictive software, which can really help you plan your inventory better and flow your goods more effectively. And finally, you want to make sure you plan for a conservative level of quote unquote safety stock, particularly in your best-selling SKUs. Essentially, invest your dollars in your core product, which you know will sell, and put less of your investment into those seasonal or niche products that have a slower sell-through.
Those are really great recommendations, Monica. Jennifer, do you have anything to add here when it comes to effective inventory management?
Yes, Monica has some great points, but let me add a few more here. Being able to actually forecast consumer demand and buying the right amount and right product is critical to having a successful year in consumer retail business. As Monica mentioned, optimizing inventory is a very difficult thing to do. It's rare that your company would achieve the perfect inventory level and mix. In most situations, you either have too much or not enough. As Monica outlined in the inventory trends for the last 3 years, we never got it right? This is also complicated by the fact that the inventory buys are done 6 to 9 months in advance, depending on your inventory category. A lot can happen or change during this period of time, resulting in a potential misalignment between production, inventory, and consumer demand. As noted earlier, most retailers are entering into 23 with excess inventory position. We all witnessed highly promotional environment in last quarter with an early start to Black Friday as early as October, first week, leading into big discounts throughout the holiday season to move this excess goods. My recommendations for managing inventory are as follows. First, enter the new year with a lean inventory position. This means you must aggressively sell through the non-carryover product throughout Q4. Second, carefully plan out your promotional calendar and strategically execute around the offers based on your product flow to maximize your margins. And third, and probably the most important point here, hire or develop a strong forecasting team enabled by adequate systems and tools. And then lastly, set a realistic seasonal or annual inventory budget and hold leaders accountable to execute on their inventory plans.
I know firsthand how challenging inventory planning can be, especially without the help of great demand planning tools. I think I'll always remember what I'll call a traumatic stockout situation many years ago and how lessons learned drove our team's strategy. So thank you, panelists, for these very valuable takeaways for our audience, especially for company teams trying to better manage risks around inventory levels. Now let's look at cash management, another key factor for all CFOs in retail right now. Preserving liquidity and maintaining adequate levels of working capital is particularly critical during recessionary times. So Jennifer, what are your go-to top 3 strategies when it comes to preserving precious working capital?
Yes, this is a really important topic, Heather. CFOs should definitely be focused on maintaining sufficient liquidity to weather through this tough 23 retail environment. Here are some basic things I would recommend. This will hopefully all make sense to you. First, ensure you're optimizing working capital by shortening cash conversion cycle. What does this mean? Make sure you collect on your receivables as fast as you can while you stretch out the payables as long as you can, right? You pay, you take your time so you can speed up the cash conversion cycle. Then try to secure a vendor financing program as this can help with extending payment terms. Second, manage inventory purchases by having a really good demand forecasting process in place and avoid building up that excess inventory we talked about earlier. Lastly, secure a line of credit for additional liquidity should you need it. This could be an ABL deal for some companies and a cash flow revolver for more larger established companies.
Great ideas, Jennifer. Thank you. Hey, Monica, what would you add here?
Jennifer really nailed it. We all know that saying that cash is king. So indeed, understanding your cash flow and your liquidity position is always important, but it's even more so heading into or within a recession. The top 3 things that I do sound really similar to what Jennifer does. And the first is around the cash forecasting process. I have my teams prepare your standard 13-week cash flow model. And in some cases, I extend this out even further to 26 weeks, particularly for companies that have far less cash runway. You really want to understand early if your cash reserves are planned to fall beneath your comfort range. The other thing is back to that inventory planning. I don't think we can emphasize that too much because inventory is one of the largest use of funds. And if you have it tied up in your overstocks or in slow moving goods, this can really put a strain on the financial health of the business. Another thing I really take a look at is not only managing my receivables, but also my payables, because that really does impact your cash outflow. You want to look to streamline your expenditures by effectively managing those payables. I often renegotiate terms with vendors or take advantage of their early pay discounts if I have excess cash. You also want to evaluate the expenditures that the company is making overall. Determine what's critical for today, what is strategic for the long term, and what actually has a favorable ROI. Cash flow during these times can really make or break a company, and CFOs have to be really aware of every penny that's going in and out of the company.
Bob, how about you jump in here? As an economist, do you have any additional thoughts about how companies can best manage cash during recessionary cycles?
Well, let me answer the question both as an economist and as a banker. I would also recommend that you sit down with your banker as soon as possible to discuss the expected cash flows and possible additional cash needs. Having a clear understanding of your potential cash needs before they arise is extremely helpful. Bankers really don't like surprises, and especially negative ones. In this discussion, you can also maybe increase a credit line, negotiate that before the actual event occurs, and therefore have a much more secure cash position to help weather the storm.
Yeah, I know from my own experience how much bankers and boards, for that matter, hate surprises. Hence the need for cash forecasting, which seems like such a basic tool for every finance team to have, but you'd be surprised how many companies don't use them. I seem to find cash forecasting being used most consistently at companies that have cash flow challenges. So these are the times. And it's like Warren Buffett said, it's when the tide goes out that you see who's swimming naked, right? Thank you, panelists, for these great pearls of wisdom. They're so timely given these recessionary times. So let's shift to the longer-term horizon for retail entities. Clearly, all retail CFOs need to consider both short-term and long-term objectives when positioning their companies for success. Monica, when you're working with CEOs and boards focused around making more fundamental strategic pivots for the longer term, what types of changes are you considering?
Heather, every company is very different, but it is very important that when you are trying to navigate the waters of a recession, that your company does not lose sight of your longer range strategies for the business. Recessions, although bad, can actually be a time when financially strong companies can actually take advantage of less competition, gain market share, and even find and hire some great talent. A few of the strategies and decisions that I work on with my clients or have in the past during times like this are really evaluating performance of different areas of the business, divesting from areas that aren't performing well and reinvesting in higher performing areas or products, leveraging also the downturn as a way to really reevaluate your team sizes and quote unquote right size. I've also looked at expanding supplier base and working with new or existing suppliers, taking advantage of these times to gain more advantageous terms for your business. And last but least, you don't want to lose sight of technology advancements. This can really be a time when you can leverage technology to streamline your processes and your processes within your business. So once you're in a recession, just don't lose sight of the longer term strategic imperatives.
Thank you, Monica. That is a really great advice for all of us to not lose sight of a company's long-term goals and to make the proverbial lemonade from lemons during a recession. Bob, another trend impacting retail, CPG, and other sectors is the work from home trend. How do you see this trend evolving in 2023 and in the future?
Well, remote work is really a hot topic right now, and it seems to be very much based on the industry sector that you're in, different strokes for different folks. As you know, most of the investment banks were asked to return to office 100% as of the middle of last year, right in the middle of the pandemic still. And some tech companies have also made similar demands. But the vast majority of the companies seem to be now utilizing a hybrid model where employees come into the office as requested, but not 100%. And some companies still allow employees to work totally from home for now, and they have not implemented a strict return to office policy. And don't forget, many companies either own their own office buildings or have long-term leases in place. So they have to pay for the office space anyhow. So as the job market tightens in this year, my guess is that the employers will start to demand more face time in the office, and the pendulum will swing again in favor of the employers.
Thank you, Bob, for those perspectives. It sounds like the jury is really still out. Hey, Jennifer, do you have any additional thoughts here?
Yes, let me share a couple of recent client stories on this work from home topic. I have a client that is going through some very challenging times right now with a declining business and an ownership change. They're in a crisis mode with all hands on deck being required. The new management team is now demanding everyone to return to the office 5 days a week, and failure to comply with this mandate would result in termination. Their belief is that everyone needs to be together to turn this business around. Then I have another client that is still permitting everyone to work from home, but the employees come in only as needed. If there's some special events that require folks to be together with no set number of days to be required to be in the office. But frankly, I'm not sure how long this arrangement will continue. I believe most companies will settle on an acceptable hybrid working model, and I highly doubt that we would ever go back to the 100% in the office again. We've proven that many jobs can be handled remotely, and work from home offers this amazing flexibility and higher job satisfaction for the employees. And I think work from home is likely to continue. I mean, who are we kidding? We're all benefiting from it. Now, see what I'm wearing? I'm wearing some really nice sweatpants underneath this pink top. And I continue, I don't want to give this thing up, right? So
I guess we'll see how it all plays out. Well, let's move on to discuss supply chains. Supply chains have been really stressed, first due to the pandemic and now because of the Ukraine war. But decisions around changing a company's supply chain are really strategic, long-term pivot points. Jennifer, how do you go about making these types of key investment decisions?
Great question here, Heather. COVID has clearly created supply chain challenges we did not anticipate. For example, if your company's vendors are heavily concentrated in China, such as Apple, this had a huge negative impact to your business as China was largely shut down during the pandemic. Fortunately, most companies had been actively diversifying their supplier base, so they're not exposed to one market or one supplier. A company's sourcing decisions are largely based on labor and material costs, factory capacity, maybe special taxes and duties in that location, and political stability. Many of my retail clients are pulling out of China at this point and diversifying their sourcing and supplier networks into other markets, such as India, Vietnam, Cambodia, and Thailand, to name a few. I'm also seeing a lot of companies are moving their sourcing headquarters from Hong Kong to Singapore, given the current political environment. The bottom line is that local market conditions and supply trends are constantly changing. You must adapt to these changes quickly, or this could end up causing major disruptions to your business.
Thank you, Jennifer. We certainly see these scenarios around shifting supply chains playing out globally. Another area where retailers are changing strategies is around their distribution channels. The pandemic has clearly had a major impact here, and the situation has been very dynamic at many companies. Monica, tell us what you're seeing when it comes to solutions around distribution channel planning post-pandemic.
Sure, Heather. The distribution model that I've seen work best for my clients, and this is both pre and post-pandemic, is to always have a multi-channel approach. And with one of those channels today being in online or e-commerce. This really proved to serve companies well during the pandemic. Early on, when we were in the first days of the pandemic, stores had closed and companies began to see a really big boom in their e-com channel. And then when the COVID restrictions softened and stores started to reopen, there was a big resurgence in brick and mortar stores as people really wanted to get back out and touch and feel and shop. Today, you see many digital native brands now moving towards having a retail or wholesale distribution as well. One great example is Allbirds. They started out purely digital and now they're moving into retail and wholesale as well. This philosophy to have a multi-channel approach is actually not so new. Even before digital e-commerce became prominent and necessary for most brands, most companies were focused on having a retail and wholesale operations, so they were multi-channel. And I even had clients that had alternative channels such as outlets and, believe it or not, shopping TV. There's not a one-size-fits-all distribution strategy, I guess is what I'm trying to say. But what is really important, Heather, is that you meet the customer where they are. One thing that I'm following with my clients is this need for customers or desires for customers to have the ability to shop online and return to store. Most of my clients aren't prepared to offer this, but they're really working quickly to stand it up. The point is, you must continuously evaluate your distribution channel strategy and also the financial impact of each.
Wow. Shopping TV, it's been a while. Thank you so much, Monica, for these insights around distribution channel decision-making. It's really, really helpful. Another critical area for the longer-term success of all companies post-recession is raising capital for growth. All companies need to lay the groundwork for future growth once consumer demand rebounds, right? So Jennifer, what is your best advice to retail CFOs when it comes to raising capital in a down market? Do you have any recommendations here for management teams and boards?
Yep, I sure do. My recommendation around capital raise is to be patient and manage everyone's expectations about the current company valuations and the realistic timeline for getting this financing done. In a down market, your company's valuation is likely to decline, or it already has, and it may take just longer to raise money. If you can afford to wait it out, that's probably the best approach to take. But I suggest in the meantime, tapping into the bank market, short-term liquidity vehicles to ensure your company has enough cash to fund your immediate operating needs while waiting for the optimal time to raise capital at more favorable terms. In the meantime, continue to build your financing network and refine your investor deck. Make sure you have the right KPIs identified and they're being measured correctly. I'm not saying it's impossible to raise capital now, but just be prepared that it will take more effort and time to get it done.
Great points, Jennifer. Patience is great advice indeed. I have one final question for our panelists when it comes to managing retail businesses successfully, especially in light of the macroeconomic trends described by Bob. So let's go back to Monica. Monica, when it comes to retail financing metrics or KPIs, what are your go-to guideposts?
Heather, there's so many KPIs for us CPG or retail companies, but I have to say that there are a few that are an absolute for me. And in each of these, I typically like to look at them as a measurement against last year and against budget or plan, just to really measure how we're performing. When I look at the overall company performance, I always measure revenue growth. I want to also look at comp growth, particularly if I have a retail business. I want to look at how I'm doing for my core stores versus my new stores and not blend the two. I always look at my gross margin percentage, particularly during these last couple of years with all of the gross margin changes from supply chain. And then I never lose focus of the bottom line, which is your EBITDA ratio. And then particularly for my retail operations, I want to follow the KPIs there that matter the most. The first being sell-through percentages. Again, you want to follow those on a unit basis, perhaps also on a dollar basis, but with price increases, the unit basis sell-through is really going to tell you more. The average price of the units, I also follow that. It's a little inflated now with price increases, but you still want to keep that measurement because it's pretty important for retail operations. And then your inventory turn, how quickly you're converting that inventory to cash. When I look at my e-commerce businesses, I focus also on some measurements that matter the most there. The first being the return on ad spend, if that ratio is in line with what we anticipated. And I also look at the customer acquisition cost, also ensuring that it's in line with anticipation. And because I also work with wholesale businesses, most of my clients have all three of these channels. I don't lose focus on the day sales outstanding for my receivables and how quickly my receivables are converting to cash.
Thank you so much, panelists. I hope this was an informative and thought-provoking discussion for our audience, from the macroeconomic trends identified by Bob to the strategies for leading retail and CPG companies identified by Monica and Jennifer. So let's go to the chat and bring in our audience. So let's see if we have anything in there. So if we don't have any questions in the chat, I have some questions I can ask of our panelists, but if anyone in the audience has any questions, please do put them in the chat and I'll be happy to ask. So my first question. So Bob, we know that the Fed is having a meeting this February 1st, I believe. So predictions, do you have a basis point hike that you think we should expect?
Well, there's a difference between what I would do and what I expect them to do.
Okay, well,
I
let's do
think
both.
I think they still have quite a ways to go because the Fed funds rate is still below the inflation rate. So they got to wind up somewhere in the 5% plus range eventually. How fast do they want to get there? I think listening to somewhat the Fed governors have been saying the last couple of days, they want to slow down the process. So I would guess, and guess is the right word, that they'll do a 25 basis point increase next week and keep going at the more measured pace, not at the fairly fast pace of 75 basis points that they had last year at almost all the meetings. So more modest increase, but they got to stay the course. Remember, Chairman Powell keeps talking about really killing inflation, getting it down to 2% again. And that is his big goal, according to which he will be measured. If he doesn't achieve that goal, people will continue to say he's the guy who lost the war against inflation. And that's something that he doesn't want to have on his name associated.
Okay, thank you. I have some questions coming into the chat now. This one I think can go to anyone really, Monica, Jennifer. What advice would you give an entrepreneur who is interested in starting an online retail business this year, given the economic landscape? Bob, you could even jump in on this one.
Well, go, Jennifer, go.
Anyone who wants to take this online retail business this year?
Looking to
Any advice?
start an online business?
Yes.
I think one point of advice is about the KPIs that we mentioned, particularly if you're starting an online business. One of the largest uses of capital is your ad spend. So you really want to make sure you set the right metrics, you follow them to ensure where you should invest more and where you should pull back if those ad spends aren't working to move the needle on your top line sales. And then with any business, I think it's very important just to have those very astute financial reviews, making sure that you have a budget in place. Since you're just starting up for the first time, you have a cash flow model in place where you're really measuring your cash runway, and that you update and follow those as really a guidepost for your business.
I would just add, make sure you assess whether you want to tap into marketplaces, digital marketplaces like Amazon, or you want to just stay on your own. That's always a huge debate. And since you're jumping into the business, cash flows may be a key for you. Make sure that you're evaluating all your investments, whether it's marketing, people. It'll take some time. Online business, so many people jumped in. It is really hard to make money. So at the end of the day, you want to make sure you understand your horizon as to how many, months or years would it take to get your business up to a point where you can scale the business. And once you can scale, that's when you start to see your EBITDA margins expand and your cash flow expand. So be patient, plan ahead, and make sure your strategy is sound.
Okay.
Well, just to add a little bit to what Jennifer was saying already, I think there's a real trade-off between reach and profitability of the channels. Obviously, if you have your own channel, you get to keep all the money. If you're going to sell through Amazon or some other channel, you got to share it with them. And you can expect them to negotiate hard also with you regarding your pricing and your positioning of the product and things like that. So it's not as easy as it can be. At the beginning, you may want to go with an Amazon just to get the global reach that they will offer you. But then if you can have your own channel, it will be a more profitable endeavor for you in the long run.
Thank you, guys. So there's a question that someone is asking online, which I think we sort of like covered a little bit. Bob, you covered this a little bit, and it's really relating to, when is a good time to buy, in light of the interest rates. It's when is a good time to buy a car or a home? I don't think anybody can really. Bob, do you want to jump in on that, and then let's Take this
Well,
2 seconds.
if you buy a new car, you gotta, first of all, is your old car still serviceable? Does it run nicely? Believe it or not, I bought a new car yesterday, but I wanted to go electric. So I got a nice, wonderful new Mercedes-Benz, and I'm a very, very happy customer. The car drives like a dream. So it depends on your own personal situation. As far as interest rates are concerned, they are pretty high right now, and probably going to go up a little tiny bit more. So, financing it, maybe not so good. You may still get some good lease terms if you cannot pay it in cash. But otherwise, given the inflationary environment, next year the car will be more expensive than it's this year.
And Jennifer and Monica, so this question, I think you guys could handle. It's asking, in your experience, which banks do you recommend, work well with CPG companies and understand their cash challenges?
I'll start. So once again, depending on what stage your company is in, so if you're early stage, then it would require different type of banks to help you support that growth. If you're more established, your size of the business such that you can easily obtain a cash flow deal, then you're looking at money center banks like the basic B of A, JP Morgan, Citis of the world. A lot of companies starting out small, you got to get to a point where you can start with asset base. You're going to be relying on your inventory and receivables as a borrowing base to get any kind of funding. For the online business, I've seen some new digital providers come into this space like Wayflyer, where they're banking on your sales forecast and they'll advance against that amount. So there are all these options. So this is a hard one to say, these are my 3 top go-to, unless I really understand the size of your company, the need of your business, the answer would really vary. I don't know, Monica, you want to add to that?
Jennifer, I think you covered it all. I would have given the same advice.
Okay. And then the last question we have in the chat is, what areas do you all think that consumers will cut back on first? It's housing, cars, or clothing. What areas of consumer spending are the first ones to suffer as the recession takes hold?
Well,
Housing.
let me start off. The housing market is already slowing down very significantly because interest rates are so high, and people don't just trade houses anymore, not only because they may have done it if they really needed to trade have a bigger house, a new house, but also the mortgage cost on the new mortgage will increase significantly over what you probably have paid in the past. So we are already seeing the slowdown in housing. Cars, there's a tremendous backlog in the car business because they couldn't get enough chips during the period of the COVID pandemic. And so it's still very difficult to get just the car that you would like to have rather than I'll take any car because I need transportation. Those are the 2 sectors that have been most impacted by the interest rate increases so far. And you'll see it now as the consumer runs out of cash, as they have maximized, a lot of people have maximized their credit lines. You'll see that slow down going into the overall retail sector. But I really appreciate Jennifer and Monica. You see it at the ground level, so to say, what's going to happen.
Yeah.
Yeah. I'll add a point of view. Heather, a lot of my clients are in the luxury space. So I would say that our customers are a little more insulated from recessionary trends. But we do have that entry price point consumer that we do see slow down. If I was to look back to the last recession, what we saw in the companies I was working with was our sales remained flat. We didn't see growth during that period, but we maintained our sales position, but our average price point went down. So the consumers they weren't buying that high ticket item. They started trading into lower prices because they still wanted a prestige product. I guess it made them feel good during that time. And so what we saw was less units being sold through in high price clothing, but we saw a lot more makeup and lipsticks that were prestige for our brand selling. We saw a lot more wallets and belts selling than we had like the high price point clothing. And so the consumer was still shopping, but they were trading into the lower price point. We also would see a huge spike during promotional periods, which I think is going to be a trend we see during this recession as well.
Very, very helpful, very great insights. Jennifer, anything you want to add or?
No, I think the points were really covered well by Monica and Bob. We can move on to the next question.
Nope, that was it for us. And I think that, we were hoping to come to this point. So I think we have no more questions. So I think thank you to all of our panelists. I am FLG's administrative partner. This was my first webinar. It was my great pleasure to moderate this event today. And we're going to be hosting additional events in 2023 as part of our leadership series. So I hope everyone who attended today will attend those as well. So please check our website for details. And thank you everyone for joining us today.
Thank you, everybody.
Thank you.